Hi, everybody. This is Anand Sonwal from CB Insights. We had a corporate innovation webinar a few weeks ago, and we had, I think, about 600 people on board and a ton of questions that we unfortunately didn't get a chance to dig into. So we wanted to come back to some of those questions, especially those that got asked multiple times, and offer up some answers and some guidance, or at least some thoughtful perspective. So, without further ado, we'll dig in. If these answers spur other questions, definitely feel free to reach out to us. You can find us on Twitter at CB Insights. Of course, on the web at www.cbinsights.com, or you can reach me directly at asonwal@cbinsights.com. So that's ASANWAL@cbinsights.com. So without further ado, I'm going to dig into the questions. I'm going to be pretty brutally honest, and offer kind of what we've seen working with corporate innovation groups, kind of digital strategy, corporate venture groups. We've really worked across the gamut, so I think we have quite a few data points. I also ran the American Express Innovation Fund prior to starting CB Insights, so have a viewpoint as a practitioner, and now kind of having seen several hundred clients who are doing this, some doing it well, some others not so well, things that work and things that don't. So one of the questions that had come up was, which company or sector do you think is doing this right and has had success in the last 5 years? And so by doing this right, we're assuming kind of corporate innovation was the question. So first of all, I don't think there's any sector doing this right. Innovation tends to be sort of company specific. It's very rarely that an entire sector is innovative. So in terms of companies, the obvious ones are Google and Amazon. They are kind of outliers. It's hard to replicate what they do. I think part of it is it's very cultural. It's in the DNA. Having founders involved, I think, also does really fundamentally change the game. Although still early, I'd throw Facebook into the mix. They've shown a desire and willingness. And again, I think with the leadership of Mark Zuckerberg over there and being founder led, a willingness to invest in and really acquire technologies and platforms that they believe could be big one day. So you see their Instagram acquisition, which was at the time people wondered $1 billion, and now it looks like a very prescient and very smart bet. WhatsApp, Oculus on the virtual reality side of things. Beyond the kind of obvious big boys of tech, you have Intel and Qualcomm. I think via their venture arms have also been quite good and consistent at investing in and accessing innovation over time. Interestingly, both are under what can be considered new management, so it'll be interesting to see how their thesis and approach to investing changes over time, or if it stays the same. A lot of the other folks are in the early days, so I think these are really more folks we would keep an eye out on. We think there's some interesting facets to what they're doing. On the financial services side, there's USAA and Mass Mutual Ventures, who we think are doing some interesting things. Salesforce within tech has also been making some pretty prescient bets within the venture side. Target on the retail side, again, these are ones that are early days. We think are, however, doing some interesting things and worth watching. Other question that came up: on average, how often do big companies try and fail to build a startup project within their company before seeing the light and doing it the right way? How many times must they bang their heads against the wall? So the honest answer is there's no way to really know this, because there's no compelling reason or disclosure of big public companies to discuss these failed projects. So we really tend to only hear about the successes and the occasional really big sort of headline grabbing failure. I think what we've seen in talking to clients is that there are different types of projects, startup projects that corporations do, and some they're actually good at. So corporations are good at delivering flavor or incremental innovation. So if you make cookies and decide that you're going to issue a new version of the cookie dipped in chocolate, corporations are pretty good at that. That's sort of, the epitome of flavor innovation. It's the discontinuous kind of disruptive innovation, and I apologize for using that overused word, but that corporations are not have not shown, with the exception again of your Google, Amazon, Facebooks of the world, that they're not good at. And so if we look at the number of big companies who've developed truly disruptive new businesses, technologies, business models, etc., the number is pretty low. And so as a result, I suspect that it's really less about trying and failing than big companies just generally don't try these things. There's so many reasons that corporations don't try these sort of disruptive things. One is, and we'll talk about these because I think some of the other questions revolve around this, but the bottleneck may be just that they don't have the tolerance or the talent to develop these ideas. What exactly do you mean with put skin in the game when dealing and partnering with startups? So on the webinar, one of the things we talked about was the amount of time that big corporations waste of startups with sort of esoteric, nebulous claims of building joint value or the creation of joint value. And what we advised was that this is all a waste of time. It doesn't do anything to build your brand. You're sort of window shopping and wasting the time of a startup. So when we talk about skin in the game, we mean money. Are you willing to put dollars behind this initiative this startup is working on with you? I don't mean free pilots. I do not mean advice on the product. I do not mean, counsel. That stuff's all pretty cheap. You might be bored in your job and it's fun to talk to startups, but that's not useful to startups usually. So I would say if it's not a pain point you're willing to put even a modest amount of money behind to solve, it's an indication that it's not a big enough deal for you to internally get a champion for, or for you to become a champion for, and two, that you don't think highly enough of the startup to solve it. So you're wasting your time and the startup's time. So, again, skin in the game comes down to money. This one's a little bit specific. Are the big professional services firms, big four and large consultancies in the venture capital game? Yeah, they are the big four. And I think even some of the other, the larger sort of consulting ecosystem is all starting to invest in venture and startups. Most are pretty young, so it's hard to tell success. I think what we have seen sort of in the early days, again, where it's hard to sort of declare this as the final trend. We'll know in a few years, assuming that they all stick with it. They seem mostly to be investing in kind of the incremental flavor innovation. So, things that might help them sell or services or products that they feel like they might be able to sell in existing engagements. It's not trying to think about reinventing consulting. So, is there sort of the robo consultant? That's not something that we see them doing. But again, that may change as they invest more. Is there an inflection point when the signals tell you that your company is vulnerable to disruption? So basically, how do you know when you're vulnerable, I guess is the question. The honest answer is every company is vulnerable to disruption. And so if you have the slide deck from the corporate innovation webinar, just look at the declining tenure of companies in the S&P 500, and it's pretty clear that it's harder than ever to stay on top. On top of that, you have this death by 1,000 cuts. So it's become increasingly cheaper for startups to be created. Again, the end state of most startups is failure, but it's really those few that succeed that you need to be worried about. In terms of signals that we do look for, I think one of them is look at what the smart money VCs are doing. So look at the industries and spaces and problems that the folks that have a history of seeing around corners are investing in. So think of Sequoia or Greylock or Union Square Ventures. What are they investing in? Their specific investments aren't necessarily the ones that are going to win, although given their investment, they have probably a better than average shot than any other startup. But the fact that they're investing in your space means you should probably watch out. I think two, look at the overall startup funding activity to your space and the types of companies being funded, and really whether the funding is kind of going past sort of seed and Series A. Because what that then indicates is that there's companies that are meaningfully moving through the pipeline and that are demonstrating enough commercial traction, customer traction to warrant sort of bigger dollars. And so that is an indication that something's going on that seems to be working, at least at the early days or in the early stages. And so if they're in your space, another reason to be worried about or thing to look for. And then the final thing is look for unusual suspects. So unusual suspects who are larger sort of corporations. So if you see telcos getting into your space and they weren't typically in your space, or Google or Apple kind of doing things, whether it's investments, acquisitions, filing patents, partnering, um, you know, that may be another sign that folks have sort of honed in on your space being ripe for disruption. And so, you'll see that in spaces like payments. When I used to work at American Express, I think we used to think of Visa, MasterCard, and maybe some of the issuers, the Capital Ones, the Citibanks of the world as competitors. I imagine if you're, at a payments company today, you're looking at what Google's doing, you're thinking about PayPal, you're thinking about the telcos. So these sort of things are, much messier. And so obviously other folks have woken up to the opportunity, not to mention all of the startups, the Stripes and Braintrees of the world. Braintree, of course, has been acquired. Automobiles is another big space where we're seeing kind of these trends, these sort of characteristics also exhibiting themselves. Insurance. But again, I don't think there's any company that's immune from this. I think that's if you feel you are, you're probably in a bad place in terms of sort of complacency and just hubris. What role within a large corporation should lead relationships with entrepreneurs? What should their individual profile be? So this is one of those kind of one size fits all type of questions. And so the answer is there's no perfect profile. We've seen a few things work. If you can recruit externally and find someone who's had some entrepreneurial success or perhaps worked in venture with some success, that can work. It doesn't necessarily mean that that's a guarantee. We see a lot of folks who hire somebody at a Google or Apple because they feel like, just having that name on their resume somehow makes them equipped to run an innovation effort or help with sort of creating a more entrepreneurial culture and taking some risks. That's just sort of logo chasing at its finest. I think with somebody who's had entrepreneurial success, it's make sure that they're not some blowhard who's sort of interested in regaling you with stories of their past successes. You want someone who will, especially if you're looking to build relationships with entrepreneurs, is somebody who's going to listen to entrepreneurs, who is going to be empathetic, who's going to be able to kind of help them. You also need somebody who's not a cowboy and who's going to be able to build relationships within the larger sort of mothership. That's important for somebody, especially externally, to be able to do. These are big organizations. Having the savvy to navigate them is important, as much as we might hope that there aren't silos and things of that sort. The other type of person, if not external, is somebody that is a well-known rising star or known star within the organization. So somebody who has access to leadership and decision makers and who is viewed very favorably. So not somebody who is in the twilight of their career and innovation is now their special project because it's sort of a fun thing for them to do. Everybody in the organization knows they're in the twilight of their career. They don't have the pull to get things done, or maybe they have the drive. The other thing I think we've seen is running innovation efforts out of the CFO's office generally is a bad idea. I think the finance function tends to be more motivated by what we think of as FOGs than FOMO. And so FOGs is an acronym for fear of getting screwed, and FOMO is fear of missing out. And so you want someone who is competitive and is looking for the next opportunity, who's sort of motivated by FOMO, and sort of the finance function tends to be more worried about getting screwed, and hence the FOGs. Kind of fear of getting screwed tends to be their primary driver, and so it's not, kind of personality-wise is often not the right fit, just because they're sort of attuned to preventing surprises, and innovation is sort of about sort of creating surprises. Next question. So CB Insights Mosaic versus understanding the business model and estimating growth. based on public statements. So it's sort of a little bit of a cryptic question. So let me try to unpack this. I think the question really is, if you're trying to understand a set of startups, how can you do that? And so I guess it's, do you understand the business model and look at public statements of the company, or do you use sort of an algorithm? And so CB Insights has sort of a private company health scoring algorithm called Mosaic. There's no, I think you can use all of these. I think it's when you use them. So I think to understand private startups, the challenge is really, how do you quickly make sense of the world? Last year, we tracked almost 11,000 tech companies that received funding. So, and if you're trying to understand a particular market, let's say it's blockchain or payments or wearables or IoT, there's a lot going on. And so going one by one to understand the business models of those companies is painful. So what we see our clients doing is taking an industry, creating sort of a market landscape, and then using Mosaic to whittle it down to those companies that have traction, looking at their momentum, looking at their money, looking at the markets that they're in. And then from there, once they've identified some of the best ones, that's when they maybe go in and do a more in-depth assessment of a handful of companies and understand their business model and the like. In terms of relying on sort of public statements by startups, I'd say don't do that. Startups tend to be founders, and I can say it as a founder myself, we tend to be sort of hopelessly optimistic. It's sort of what you need to be when you're a startup founder. So obviously their statements to the media often tend to be, flowery, to put it mildly. So, that optimistic guidance is good, but I think there's much better signals that you can discern about companies using data than sort of listening to what they're saying, unless you're willing to just haircut everything they say by a significant amount. Next question: do you think corporate ventures should choose a GP to invest with? So again, this question could go in two ways. I'm going to answer both of them. I think if it's referring to should a corporate venture syndicate with a traditional VC and co-invest with them, I think this is fine. What we're seeing today is that, as the climate sort of turned, we're seeing some of the traditional sort of venture GPs who have sort of dogs in their portfolio coming to corporates to try to get some of that proverbial dumb money. And so I think that's one thing you want to be careful about as a corporate, is that make sure that they're not bringing you sort of the laggards in their portfolio, and that they're also investing, and that, you've done your diligence on the business and don't just rely on the GPs. But, venture, if you're doing investment, is obviously syndication of deals is really important. And so building relationships up with a GP or many GPs is very important. If the question is, can we access innovation by investing in a GP, so a LP relationship with a VC fund, this is, in our view, and based on what we've seen, a pretty terrible idea. It sort of just doesn't make sense to try to access innovation by investing in a single GP when you can invest alongside any number of VCs down the road. So why bet on one horse when you can bet on really the whole kind of group of VCs that might be making relevant bets. So I'm not sure as an LP to access innovation it makes sense. If you want to invest as an LP because you believe there's financial returns and that's interesting in the company, it's a different story. But as a access to innovation, it doesn't seem to make a lot of sense. With a strengthening dollar, will we see more interest from US corporates and European startups? So we're seeing, we're talking about accessing innovation. So if currency and exchange rates are driving your innovation efforts, I think you're doing it wrong. When we look at sort of the markets for startups and things, Europe is kind of clearly the bronze medalist for corporations. North America and Asia are far ahead of Europe. There just is, I think, North America being sort of the hub with Silicon Valley, and then New York and Massachusetts, followed by, I think even Canada now increasingly has a pretty active and thriving scene, is a big market where really kind of a lot of the innovation does begin. Asia, given its size and relative nascency when it comes to kind of some business models and technologies and other things, and sort of it being a more greenfield opportunity is another big area. But Europe, there just doesn't seem to be as much interest from corporates in Europe, and the European corporations themselves tend to be kind of hopelessly conservative. We don't see any impetus for investing in Europe by corporations. To be very honest, it does happen. It's just, I think, as far as markets go, it's going to be North America and Asia that are going to kind of really be the lion's share. How do large corporations balance the needs of capital markets, i.e., delivering quarterly and yearly results, shorter-term ROI horizons, against investing in innovation, experimenting, and allowing for failure, and things that require a longer time to deliver ROI? So this is the million-dollar question, or the billion or trillion-dollar question. This balance is incredibly hard, and most corporations suck at it. That's the honest reality. It's why startups exist. If big corporations were these nimble entrepreneurial organizations that could come up with these ideas and actually execute upon them, then there'd be really no reason for startups. But they don't, and they can't. So that's why startups exist. It's hard to balance because innovation is long-term focused and the public markets are terribly short-term focused. And unless you kind of are like Bezos and Amazon and have told people that, don't expect anything in the short term and gotten them trained on it, it's hard to do. But once you've kind of trained them on quarterly results, it's hard to reorient the street to thinking, even to a yearly level. So, and the reality is, if you're an executive at a publicly traded company that has these short-term horizons, you are gold, and your job is dependent upon delivering short-term results. And if you don't do that, you're not going to be around for the long term. So investing in innovation becomes difficult. Second thing is incentives. So the nightmare that has become delivering shareholder value. Executives and the rank and file are compensated generally on short-term metrics. So, and this disruptive sort of discontinuous innovation takes years, 3, 5, 7, 10 years. And then I think the third factor is that, to be very frank, most corporations don't have the right people to do this stuff, right? So you need to attract and retain really bright entrepreneurial people to come up with these ideas and execute upon them. And so innovation, which is, let's say, 1 part good ideas and 2 part great execution, are hard to pull off because the talent at big companies is not well suited to this. Whether the ideas are really good or just sort of incremental is the first challenge, and then whether the organization is set up to actually help those people succeed is the other problem. So even if you have the great idea, which is often in short supply, is the organization set up to help you succeed? And if you fail, is it career limiting, or is there a place where you can actually go and not be kind of in purgatory? And if you succeed, is the upside, an extra 2K in your bonus or 5K in your bonus, or is it meaningful kind of compensation and reward for building something big? And most corporations haven't figured that out. Another undervalued currency question. So with undervalued currencies in Latin American countries, which are at a discount, startup in VC is also on the rise. Do you do any market analysis for countries like Brazil, Mexico, Colombia, Argentina, Chile? So we collect data on LATAM. Again, I'll just restate the earlier point. Undervalued currencies are not the reason that folks are going to look at LATAM for innovation. Innovation does not come by trying to time currency and exchange rates. So again, there's a big opportunity there, and that currency tumult is probably, though, not going to be the driver of somebody investing in innovation in Latin America, as far as we've seen. The biggest roadblocks to building a truly innovative corporate culture. So I think we've talked a lot about this in some of the other questions, so I won't kind of belabor it. I think it's the ability to look at a time horizon that's sufficiently long and put resources behind it and commit those resources and not pull back at the first sort of market correction. Having the right people who can come up with the ideas and who can actually execute upon them, and having sort of the organizational structure to do it. And then the incentives, which again, people do what you pay them to do. And so if those incentives aren't right, it's going to be hard to get this sort of innovation to be culturally sort of accepted. If you had to kickstart a corporate accelerator that actually worked, how would you do it? I would avoid building a corporate accelerator, but that doesn't answer the question. So here's the things I would do before you start the accelerator. So I think people start the accelerator, they get the announcement in TechCrunch, and then they feel like they've done something and they've actually done jack. So I think there's a few things. One, I'd say have a tight thesis around what you're interested in your sort of first class before you start. So we see lots of corporate accelerators go out and have these very vague, we're interested in insurance tech or retail tech. And so I think being specific in the beginning will help you get companies that are interesting to you, and also companies that are interesting to the people that are internal, right? And so I think, you can always expand the scope down the road, but I think being specific about what you want is important. So spending some time developing that idea is important. Two, before starting the accelerator, kind of go out and identify, and you can do it on CB Insights, or you can do it with lots of Google searches if you want to waste time, is develop relationships, identify, and then ultimately develop relationships with the seed and Series A investors. So these are the folks that are going to be funding the companies that are coming out of your accelerator, and that's going to be how you build up your brand, right? So you want companies that come out of your accelerator to have access to investors and ultimately close that funding. And so I think identify every single investor in the spaces that you're interested in at the early stage, find out what they look for, and build that relationship. This will help get your companies funded, and later on that'll be a metric of success you can point back to. And then the third thing, again, doing this all before you launch the accelerator, is find entrepreneurs in your space and help them out. So reach out to startups. You have no equity stake in them. You have no accelerator at this point, but just reach out to startups who are relevant and meaningfully help. Pick a number, 3, 5, 10 of them. Become a customer, i.e. pay them money, help them if they're early, get in front of prospective clients and understand your needs more. And the idea after you've done that is to go back to them and ask them if you were actually meaningfully helpful to them. And the reason for this is twofold. One, you will understand how to be helpful when you launch your accelerator. And two, you will build some references that you can actually use with future accelerator classes. So, the ability, you want to attract not the third tier companies. And so part of attracting the best companies and the best founders who probably have options is by helping them understand that you're going to actually be valuable, and not a waste of time for them. Last few questions. Are you seeing more CVCs co-investing together? Yep, absolutely. So CVCs, even from competitive industries, so people who might be competitors, are increasingly co-investing with each other. If it's good for the startup, I think the smart VCs now know that they should do it and shouldn't try to box out competitive VCs in those situations. That's not the kind of reputation you want to build in the entrepreneurial community. Proprietary deal flow, one of my favorite phrases. It no longer exists, which is an excellent point, but what are the most efficient ways to build the best deal flow? So let me self-promote here. You should be using CB Insights. I think finding the deals is not the hard part anymore. The hard part is becoming the investor that the best entrepreneurs want to work with. So you can spend a lot of your time running around, going to demo days and all that good stuff, or you can spend time, in the prior accelerator example, building relationships and helping entrepreneurs out, and then as a result becoming the investor that entrepreneurs believe through their participation changes the odds of success of their startup in a meaningful way, right? So if you're able to do that, you will win deals that other people may have a difficult time winning. And so this is what your storied firms in the venture world do. They may have some proprietary deal flow, the really elite firms, but I suspect now it's less about proprietary deal flow because all the deals are sort of out there, and more about the fact that entrepreneurs want to work with some of these firms more, and that's sort of the reputation I think you want to build, versus trying to chase this elusive and basically non-existent idea of proprietary deal flow. Final question. What have you seen in terms of successful organization/leadership models for corporate innovation? Again, I'm going to bang on sort of the same drum. The successful models have the right talent, the right incentives, and the right outlook from a time frame perspective. So on talent, they tend to hire from the outside or, put a star in place, as I mentioned earlier. Tend not to put them on the normal sort of corporate salary and incentive scheme. Often, I would say generally, they don't put the CFO in charge of it. They don't hire some big consulting or advisory or strategy consulting firm to lead their innovation efforts. That one always baffles me. Why hire a firm that is not viewed as being terribly innovative themselves? But people still sometimes do that, surprisingly. I think when you do that, it's also incredibly demotivating to folks internally to have some talking head come in and regurgitate what they've likely already been saying. I think those are things not to do. Again, not putting somebody who's plateaued within the organization in charge of the innovation efforts as sort of some sort of strategic project. Again, sort of a quick sign that when we see that we know that the effort is likely not to yield the results that folks are after, or it's just paying lip service. It's sort of doing the innovation theater thing that we see quite a bit. And I think the other thing is that successful sort of models commit resources up front. They kind of have carved out relatively explicitly, and of course, managing quarterly and annual earnings if this stuff does change, but they sort of have committed for 3 to 5 years from the start. So it's not hey, we're going to evaluate this on a yearly basis. Of course, you're evaluating it to make sure that stuff's actually happening, and not blindly trusting it. But you're also not expecting that some disruptive, discontinuous kind of innovation or product or business model gets built in year one. You want to see meaningful traction and progress towards something, but again, not evaluating it on an annual basis. So those are all the questions that we got. That we could understand. To be honest, I hope that was helpful. Again, if any questions, definitely feel free to reach out via Twitter at CB Insights. You can always, again, visit us at www.cbinsights.com. If you're not a client, sign up for a trial. I think you'll also be able to see a lot of the data and things that made up the presentation and some of the ideas that we talked about here. And then, of course, my email, asanwal@cbinsights.com, ASANWAL @cbinsights.com. But yeah, we think there's a lot of opportunity here done right, and avoiding sort of some of the innovation theater that we see. So hopefully this has been helpful. Thanks again for listening, and we'll talk to you soon. Bye.